Looking for a dividend growth stock that offers a market-smashing yield of near 7%? Want some growth on top of that huge yield? Would you like to be at the center of two megatrends? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing millions of consumers with telecommunications and digital entertainment services. All of those smartphones that are like a new appendage, yeah, they need mobile networks in order to work. Well, this company is one of the largest such network providers in the world. How about all of that streaming content people are getting at home now? This company is also fast becoming one of the largest such streaming providers in the world. That 1-2 punch could lead to a lot more profit and dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of AT&T Inc., which appear to be trading at a significant discount today. AT&T Inc., stock ticker T, is a multinational media conglomerate that provides communications and digital entertainment services in the US and internationally. Co-founded by Alexander Graham Bell in 1885, AT&T is now a $216 billion by market cap media juggernaut that employs almost 250,000 people. Fiscal year 2020 operating revenue breaks down across the following reportable segments: communications 79%, WarnerMedia 17%, and Latin America 3%. Their largest segment, communications, provides wireless and wireline telecom, video, and broadband services to millions of consumers. They're one of the largest telecom companies in the world. If that's all they were, it'd be impressive. Smartphones are almost an additional appendage at this point, and mobile communications and data is practically as important as electricity now. But they have a very significant media business on top of it. WarnerMedia, through major properties Turner, Home Box Office, and Warner Brothers, develops, produces, and distributes feature films, television content, and other digital content across a variety of platforms. AT&T is vertically integrated with their media content, acting as both a major producer and distributor of content. The distribution side of the business has been amplified of late as AT&T recently fully launched their much-anticipated HBO Max streaming service. AT&T's debt-fueled foray into media through their $85 billion Time Warner acquisition in 2018 has generated more questions than answers thus far. However, the timing might have been fortuitous. Streaming has never been more important for both companies and consumers than it is now, especially after the pandemic struck in 2020. More people than ever before are streaming content. That bodes well for AT&T in two ways. First, there's the increased demand for broadband, which they offer across both wireless and wired connections. Broadband demand is growing, particularly with more decentralized work after the work from home theme developed. Streaming only serves to bolster that demand, and with 5G just now rolling out and AT&T set to become a major 5G provider, AT&T's position will strengthen. Second, now acting as a major streaming player, they now have a growing audience and huge addressable market for content production and distribution. If there was ever a time to jump into streaming with full force, it's right now. That's exactly what AT&T is doing. This 1-2 punch should translate to growing profit and dividends over the long run. AT&T has already increased its dividend for 36 consecutive years, making them a dividend aristocrat. And while the 10-year dividend growth rate of 2.2% is nothing to write home about, you have to consider that this stock offers a market-smashing yield of 6.9%. That's more than 4 times higher than the broader market's yield. It's also 110 basis points higher than the stock's own 5-year average yield. Oftentimes, a yield this high indicates an unsafe dividend. However, I would argue that this is an exception. The payout ratio is only 65.4% using fiscal year 2020 adjusted earnings per share. Moreover, the free cash flow payout ratio for the full year came in at only 55%. I see the dividend as safe. That said, AT&T has missed its recent schedule for normal dividend increases. They've been focusing on their HBO Max launch, 5G rollout, count and balance sheet deleveraging efforts, but I suspect that AT&T will make good on this within the next quarter or two and hand out their usual 4 cents per year dividend increase. This is a slow growth, high yield stock that might be perfect for retirees, income investors, or just investors who want to amplify the overall yield of their portfolio. Looking at business growth, AT&T grew its revenue from $126.723 billion in fiscal year 2011 to $171.760 billion in fiscal year 2020. That's a compound annual growth rate of 3.44%. This is actually not bad top-line growth for a mature business, but the aforementioned Time Warner acquisition drove much of this, so this was far from being totally organic. Meanwhile, earnings per share advanced from 66 cents to $3.18 adjusted over this 10-year period, which is a compound annual growth rate of 19.09%. While exceptional, I think this is also misleading. AT&T routinely adjusts its earnings per share up and down to account for a number of items that impact GAAP earnings per share. Many of these items cloud the earnings power of the company. The growth can look good or bad depending on what period you're looking at and what adjustments were taken. If we move past earnings per share and go straight to cash flow, free cash flow per share went from $2.44 to $3.82 over this period, and that's a compound annual growth rate of 5.11%. That would be a more accurate view of the true growth profile. Looking forward, CFRA believes that AT&T will compound its earnings per share at an annual rate of 3% over the next 3 years. I think CFRA's forecast is perfectly reasonable. On one hand, AT&T has a lot going for it. They're at the center of two megatrends, 5G and streaming content. Regarding the latter, they now have more than 41 million total HBO and HBO Max subscribers, which is running far ahead of initial company expectations. HBO Max goes international in June. On the other hand, their large size, debt load, and questionable management choices have worked against them. All in all, AT&T doesn't need to produce blockbuster growth in order to be a suitable long-term investment. It's basically a bond proxy, except the yield is much higher than you'd get with almost any bond. Plus, there's a small growth kicker in there. It is what it is, and you know what you're getting here. It's an income play, and there's nothing wrong with that. I think AT&T will continue to produce low single-digit business growth, which should translate into like dividend growth, and it's not hard to like that when you combine this dividend growth with a near 7% yield. Moving over to the balance sheet, this is the worst part of the business. The long-term debt-to-equity ratio is 0.95. There is currently a non-applicable interest coverage ratio as AT&T took a GAAP loss for fiscal year 2020. However, the interest coverage ratio for fiscal year 2019 was just over 3. It's worth pointing out that the company is attempting to deleverage the balance sheet. Net debt dropped by $3.5 billion for fiscal year 2020. Furthermore, they announced a spin-off of their video business unit comprised of DirecTV, AT&T TV, and Uverse, which will be 30% owned by private equity firm TPG Capital. AT&T will own the other 70%. This deal, which is expected to close in the second half of 2021, will provide AT&T with almost $8 billion in cash. The company plans to use this capital to reduce debt. I'd very much like to see them continue to chip away at their approximate $150 billion debt load, and with their significant free cash flow, they can afford to do so. They'll simply have to manage the business properly, grow their subbase, and be prudent with spectrum auctions. Profitability is relatively robust for the business model. Over the last 5 years, the firm has averaged annual net margin of 10.13% and annual return on equity of 11.73%. If you're looking for a stock to safely juice the yield of your portfolio, I think AT&T should be top of mind. And the company's durable competitive advantages include scale, vertical integration, and key mobile technology. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. AT&T's maturity and size will naturally limit growth. The balance sheet is highly levered and has created inflexibility. Paying down debt will divert cash flow and stifle future M&A opportunities. Rising interest rates would make the debt less manageable and the stock's yield less relatively attractive. Their streaming efforts are off to a great start, but this is still unproven in terms of long-term profitability. Also, streaming moves consumers away from the legacy cable bundle, and any major technological change in the way people communicate on devices would have implications for the company. Overall, I see AT&T as an appealing dividend growth stock for income, and with the valuation being undemanding, it's made to be that much more appealing. The stock trades hands for a price-to-earnings ratio of 9.5 based on trailing 12 months adjusted earnings per share. That's obviously much lower than the broader market. Some of that discount seems appropriate, but the expectations are very low here. It wouldn't take much for the company to surprise to the upside. The price-to-sales ratio of 1.3 is also slightly off of its 5-year average of 1.4, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate due to the high yield and a long-term dividend growth rate of 2%. This dividend growth rate is slightly below the company's own demonstrated long-term dividend growth rate. It's also slightly below CFRA's near-term earnings per share growth rate forecast. Assuming AT&T keeps up with its recent trend of a 4 cent per year dividend increase, that would represent an approximate 2% dividend increase off of the current $2.08 annual dividend, and that's where I believe AT&T will go. I don't see the company knocking it out of the park. These are low expectations, and I'm not aware of any reason why they can't at least meet these low expectations. The dividend discount model analysis gives me a fair value of $35.36. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates AT&T as a 4-star stock with a fair value estimate of $36. CFRA rates AT&T as a 3-star hold with a 12-month target price of $35. We have a super tight consensus here. Averaging the three numbers out gives us a final valuation of $35.45, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. AT&T Inc. has built an impressive telecom and media conglomerate that's vertically integrated and positioned at the center of two megatrends. With a market-smashing yield of near 7%, more than 35 consecutive years of dividend increases, a well-covered dividend, and the potential that shares are 17% undervalued, this dividend aristocrat might be perfect for dividend growth investors looking for income. And now for a special news announcement. Microsoft Corporation, stock ticker MSFT, just landed a deal to deliver over 120,000 HoloLens augmented reality headsets to the US Army. This contract could be worth up to $21.9 billion over a decade. This is massive. One of the biggest and best tech companies is now turning into a major defense contractor. We produced a video last year calling Microsoft's Dividend the safest in the world, and this contract only solidifies that view. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.